All right, so welcome to another video. Today, what I want to do is just chat a little bit about recessions. Does a recession mean a bad return in stocks? And in the stock market, you probably have a big, serious answer of yes, it does. And I'm going to share with you some data here from some analysis, some history, and that kind of thing, and just give you some perspective, and also just give you some thoughts and tidbits about just trading overall in general. Again, so if we're talking about long-term investing versus we're talking about just active trading, there's a little bit of a difference that you have to kind of discern when you're doing some stuff like this. So what I want you to first reference is one of these people. This is Mark Douglas, who talks about trading psychology and just overall trading in general. So he passed away not long ago, and there's a lot of takeaways from a lot of the videos and books that he's done. He's done Trading in the Zone. So if you start looking at a lot of these books, they are big sellers because he's mentored and worked with a lot of big time traders over the years. Anyway, so the big key takeaway that I want to mention here is that if you study any of his materials, one of the things to really learn about just the act of either investing or trading is that anything can happen. So if we look at kind of just overall recessions, oftentimes in general, recessions do have a bad return in the stock market, but it doesn't always happen. So that's why I reference some of these videos, is because when you start looking at just overall trading or investing, anything can really happen in any given trade, because somebody could come in and it could start, flipping on a dime very quickly and pushing stocks further higher to the upside, or vice versa to the downside. Now, in general, when you have a recession, stocks do go down, but it's kind of like in general, if you're, let's say, going fast and speeding, you have a higher degree of risk of a crash with another vehicle, but it doesn't always happen, right? You've probably sped at some point on the highway and you didn't crash. So we know that that is not always equal. So it's not an always thing, right? Just because you're speeding over the speed limit, let's say the speed limit's 80 miles an hour, just because you're going 81 does not mean you will crash and die, right? But it does increase the chances. So the same thing here is, just because we have a recession economically does not mean the market itself or the stock market will crash. And why does that happen? Well, there's a lot of different reasons. It could be there's some positive outlook. There could be money pumping of some sort. So there's a lot of things, but I want to point to you, here's a Forbes article just real quick. And then we pulled a chart out of this Forbes post if you just do some research. And again, you could back check this with some charts, which I've done some due diligence on some of the recessions, but not as much as here, because they actually go back even further to like 1953. So I didn't go back that far back, but I looked back at the last couple, and it seems to be kind of in line. So I'm going to go ahead and take their word on it. But just in general, if your mindset is always thinking like, hey, anything can happen, you can see that, look, during a recession in 1953, and you start looking at it during the recession, actually the market return right there was 18%. 1957, you had another recession, but the market was down only 4%. Or in 1960, again, you're up 17% during the recession, but 6 months before you were down. So you could see some of this data here, but what I want to point to is that during the recession itself, the market isn't always down and it's not always up either. So you can't really find an exact trend to it. But the point is that every condition, every situation is unique. So you have to trade it in a different way. And, anybody who says, hey, well, the market's going to sell off or has more sell off further and later, it's quite possible. If you get into a recession, you have a higher chance or higher degree where stocks can pull back because then economically you're weak. People are, less looking to invest. They have less capital to push into the markets. So there's a lot of negative things that do push that. However, if you look at just kind of the spending power of the housing market just recently, right, a lot of people would think, hey, well, there's a lot of people that have layoffs, house prices are going through the roof, but yet still people went ahead and bought more expensive houses and they still went and made it happen. So in either case, my point here is that if you're starting to look at just overall a recession, it does not mean things will plummet. But yes, you do get some of these things in 2007 where you're down like 37%, but then other times in 2001, you're down 2%. And then in 1990, you're up 5%. 1981, you're up 6%. 1980, you're up 7%. So you could see some of these recessions here that even though there's some contraction economically, sometimes you're down a bit more, other times you're not. So it just really depends how you come into it and what you're kind of looking for. And here's kind of the length of overall the recessions, which is something to kind of pinpoint out. Look, it lasts about a year or so. This one's 1.33 years, 1.33. So they kind of average about 1 to 2 years is what I looked at. And if you look at the kind of the chart on the SPX, S&P 500, and we look at just the 2009, I just look at the big drawdown right here from here to the peak to the bottom. This was 1.4 years or 17 monthly bars. So 1.4 years right there. This one right here from the peak to kind of the lows, again, 2.6 years on the downside from the year 2000. So I look at it that way. Obviously, they're looking at it from a recessionary standpoint. So it's a little bit different. It's fine. But, you're looking at about two years or so at the most. And even then, the returns aren't always negative. So don't let it freak you out too much from the standpoint of, it's going to crash just because we're in a recession. It doesn't always equal that. Remember, just because you're speeding does not mean you're going to crash and die in a car. So it does increase the chances. It does increase the risk to go faster and faster and faster, right? The faster you go, if you go 150 miles an hour versus like 80 miles an hour versus 30 miles an hour, you do increase the odds of that situation happening. But it's not a direct correlation and it's not a direct cause and effect. Okay. You're looking at probabilities here. And that's just what I wanted to share with you here, is that people that get too wrapped up into these details can be overwhelming, that you can throw data all over the place, but the reality is that just because you're in a recession doesn't mean you're going to have a bad or negative stock market. And right now what's been going on is, if we really look at just the market itself, we started pullbacks on stocks like Zoom already months ago, and just because they were overvalued. So could you get in a recession and these things go down to even further? Yeah, like 60 or 50? Sure, it could. But you've had, some of these things already start pulling back, just like Starbucks been pulling back for a while. And, and if now you're talking recession, well, yeah, you're already down from the highs at a discount of 41% from this stock. So how much more do you want to go? Do you want to go maybe 60%? And that's a huge pullback, right? A 60% pullback in a stock is huge, and it could happen. But from looking at a long-term perspective, look, do you want to go to the year 2000 levels? Look, you're not going to go down to $1.49 on Starbucks. I doubt it. They just have a lot of real estate. They have a lot of stuff in there. Will you go to $4.30? Probably not. So maybe, hey, if really people panic, let's just say you go down to $20 a share. At $20 a share to own Starbucks, that also means a lot of other companies will be breaking down in a big way. So that'll put you back into 2006, like 15 years back. Possible? Maybe with a panic, flash kind of crash type of thing. Possible. So because anything's possible, you have to look at it from that perspective. But is it likely? Probability of that? Probably not. So maybe 29, maybe 30. It's more realistic. Could it go to 50? Yeah, much more realistic, because now we're already at 78. But, already these things have pulled back quite a bit from a monthly basis. And you can see even here, the last pullback, quite a bit pulled back, 49%, and then we powered higher. So, and over here, from here to here, we've pulled back in the last recession, 82%, right? So that's where we want to think about. So what if we pull back 82% here? Okay, so that'll give us, let's go about 82. That'll get us right there at that $20 a share. So that's where you kind of like, look, if you really panic, possible. But again, the chance, the probabilities, again, you got to have, there's a sliding scale here that goes with it. That just means a lot of people are dumping shares. A lot of people are cash reserved, holding it on to it very tight. And that's kind of what you're going to maybe see if this thing goes down to $20 a share. So, and that goes along with a lot of other stocks, like let's say Microsoft, again, top E, we're at the top E level. So if we had pullbacks like over here, right here, this was 1.2 months. We go into the monthly here. Here's the 2000s. The stock pulled back. That was 66% pullback. This one, 2008, 2009, that was a 59% pullback. So let's say we go 60% down from here. So we're going to go down about right here. So that's kind of actually this line where I marked it. So that puts us right back into about $1.33 or $133 a share. And that's kind of the swing low over here. And that's, I'm saying, like, if we really panic and we crash, I think you'll still have like a $200 possible support, and it'll take bounces in there. And, that means like the full year, you're kind of just trending down, bounce, trend down, could last 1 to 2 years and maybe, but then again, you'll be at a super low dollar value and you might be able to nibble on that stock at a way cheaper price. So it's just my take. Again, anything could happen. Just because you got a recession doesn't mean you'll go down, but it's something to kind of say your odds of going down do increase, but it doesn't necessarily mean it doesn't equal down. But don't get too crazy to the point where you got to dump everything, where instead you might want to be a little more conservative, buy a little more protection, be a little bit more cautious, and that's maybe a smarter approach. Anyways, thanks for joining me. Enjoy the rest of the week ahead, and I will see you guys next time. Don't forget to grab some freebies also on the website. Take care.